Hey everyone, so with just a few trading days left in the month of August, it's time that we start preparing ourselves for what historically tends to be a bit more of a volatile period here into September and October. Of course, this year we have the COVID-19 situation to deal with. We have an election coming up, so I think it's definitely a good year to start preparing for a bit more of a volatile period ahead, and I do actually think that the last few months of the year are going to be quite eventful and i.e. volatile in the market. So let me move on to this and just I have a couple of charts ready to give you some perspective on this. First of all, if you look at historically speaking, the month of August, or the two back-to-back months of that have the weakest performance all year, tends to be August and September. Now, it's the combo thereof. It's not necessarily that both of them have to be down badly. August so far, with just a few days left, is good, really good performance. So maybe September is going to be weaker. Just to give you that in perspective, for some perspective, you can see all the other combos back to back have a much stronger performance. Historically speaking, if you look at the 4-year presidential cycle, like the year we're in right now, basically, since 1928, there's a pattern that emerges. And this is a piece of research that came across, I think, last week. And you can see, typically speaking, June, July, August tend to be rally months in this 4-year presidential cycle. And then you tend to see a weaker September and October as people are probably a little bit more nervous. There's more back and forth, more information to digest of maybe, opposing directions. And then once you get past the election, you'll tend to see sort of a relief rally, if you want to call it that, into November and December. And this is representing the S&P 500. So I don't know if it's going to work out this way this year, but since 1928, that is the historical tendency. So, again, a reason to be more cautious here heading into September and October for that, because of that. Volatility in terms of the markets, implied volatility tends to increase the closer we get towards the election. So even though this August we actually have lower volatility than we had in July, I am about as certain as one can be that we will have higher volatility, realized actual volatility in the market as we head into September and through October. And then if you look at the VIX term structure, this is kind of like the futures curve of the VIX, so the S&P 500 implied volatility. You can already see, and this is not a historical chart, this is the actual current chart. You can see that the VIX futures for October are like closer to 30, and the September expiration is closer to, the mid to high 20s. So the futures market is already pricing this in. This is the actual fact already being priced in. So, there are many ways to prepare for higher volatility. We like to keep it simple, and we like to stick with truer things. So what we are going to do, and we haven't done it yet, and we will be doing this both on the research side for the Steady Trader, as well as for Blue Marlin Advisors as our registered investment advisory company. We are probably going to start buying some very simple put spreads using options expiring probably out in December, at the money, nothing complicated. But as we start to see more volatility, we will then see the price of those options increase because the implied volatility goes up. And of course, if the market does at least come down somewhat, which I think is probably reasonable to expect from here, then that'll also, of course, benefit that position. So this could be both a hedging position, this could, as well as an outright bearish position you want to put on, if you want to put it on through September, October, and maybe take it off before the election would be our guess, just because you don't know what the outcome is after any major event like that, whether it's earnings or an election. So that's what we're looking to do. Very simple and straightforward. Basically looking to profit from an increase in implied volatility. The VIX, we're thinking the VIX will be probably closer to the high 20s, if not the high 30s. Quite frankly, we could get there. So the increase in implied volatility and potentially some sort of a pullback in equities this autumn would be something that would make sense to us to position for that using a trade like this. As always, folks, I hope you enjoyed this. Give us a thumbs up, subscribe, and spread the word. I'll see you guys soon.